and in a very easy manner, so that no one feels a little bit left out or a little bit bored during this session. Okay, so we'll quickly jump off. Uh, okay, so before starting with the session, I would like to bring your key takeaways in front of you. First of all, we will be discussing what actually derivatives are. Then we will jump on to what futures are. We will understand some important terminologies that is used in futures market, and then we will wrap up the things with a very small recap about whatever we have discussed, so that everyone gets updated and everyone finally gets concluded that yes, these are the topics that we have already discussed. Okay, so the very first thing, what actually is derivatives? A security whose price is dependent upon or is derived from an underlying asset is known as a derivative. Its value is determined by fluctuation in the underlying asset. The most common characteristic of a derivative market, or the thing which usually attracts people towards it, is in this market you have a very high leverage, like a very good leverage is provided to you while you are trading in derivatives market. How and what actually do I mean by high leverage? We will discuss this thing in upcoming few minutes or upcoming few seconds only. I might it might have. Okay, so the most common underlying assets are stocks, commodities, currency markets, and market indices. With market indices, I mean Nifty and Sensex. Okay, so this is something which is a theoretical concept, but in order to understand things better, we have a very good example for you all. If you can see what comes in your mind if you see bread, a chapati, and a biscuit in front of you, what is the common thing that is with this, that is there in all these three things? It is wheat.
The
Yeah, exactly. So it is wheat. So in our case, wheat is an underlying asset, and bread, chapati, and biscuits are its derivatives. Okay, so in case if the price of wheat uh, increases or decreases, it will certainly have an impact on the prices of bread, chapati, and biscuits as well. Another example could be, say, butter, ice cream, and curd. So, what is the common thing between butter, ice cream, and curd?
milk,
Exactly. So, milk in our case will be an underlying asset, and butter, ice cream, and curd will be its derivatives. Quickly moving forward to what are the different types of derivatives are. Uh, there are basically five most popular derivatives. First one is forwards, futures, options, warrants, and swaps. But majorly, most of the people know about futures and options only because these are the uh, most popular among all these five. And we will be also covering only these two topics in our sessions. That is, the first one is futures, and tomorrow we will be covering options. So, what actually futures is? It is something which I will let you know in coming time. But before starting with futures, it is important that we know something about forwards, because forwards will lay down a foundation base for you all to understand what was the need of futures and what actually futures are. Okay. So to understand forwards better, I have a very good example for you all. Say uh, the current market price of wheat is 50 rupees per kg, and I think that in upcoming 2 months, the price of wheat might go up and up to the extent of 65 rupees per kg as well. Okay, so what I will do is, I reached a farmer, and since the current price is 50 rupees and I am expecting it to go to levels of 65, what I thought is, let me present an offer to a farmer, and I like reached him and made a deal that yes, after 2 months I will be giving you 55 rupees per kg for 10 kg of wheat. For a farmer over here, it is a profit because the current market price is 50 rupees only, and if he will go with this only, after 2 months also the price will remain 50, but over here he is getting a chance to earn 5 rupees more per kg. And for me, I think that although it could have been my profit, like my profit could have been 15 rupees, it's okay that I earned 10 rupees also. So I have made this offer, and he has accepted it. So now what will happen is, there might be 2 or 3 situations, like say after 2 months the price of wheat went down to 45 rupees per kg. So in this case, what will happen is, the farmer will be in profit. Why? Because I have already I have already dealt with him that yes, after 2 months, I will be purchasing this 10 kg of wheat at rupees 55, whereas the current market price is only 45 rupees right now after 2 months. So this is my loss of 10 rupees, whereas it is a profit of farmer of 10 rupees only. Okay. Similarly, in another situation, what can happen is, like whatever I thought, yes, the stock, the wheat might go up to a level of 65 rupees per kg. The same thing has happened now. So in this case, I will be at profit of 10 rupees per kg. Similarly, the farmer with whom I made a contract is at loss of rupees 10 per kg. Okay, so in such scenario, since there was just an oral communication, we did not sign any formal contract among each other. It might happen that yes, at this level, like in this situation where the current market price is 65 rupees, and I am purchasing it at 55 rupees, the farmer might tell me that no, he's not at all interested now to sell the wheat to me at rupees 55. Is it possible? Because he is having a loss of 10 rupees per kg. So since I have no proof that we had a contract among each other, there might be a situation where he might tell me that no, I don't want to sell it to you now. Can this happen? Guys, please reply. Hello.
Yes, sir, it can happen.
Yeah, and similarly, like in another situation where the current market price is at rupees 45, and I had told, I have already dealt in dealt with the farmer at rupees 55 rupees per kg. In that scenario, I might go to the farmer, or I might not reach farmer as well. Like, no, I am not at all interested in buying your wheat at 55 rupees per kg, because I am getting it from market at 45. So why do these things happen? Because there is no third party between me and the farmer. There is no binding contract which will bind us to book our loss or to book our profits. Similarly, what other thing can happen is, say the farmer had a very huge land. His total production was of say 100 kgs. I was the one who made a deal with him at rupees 55 per kg. There might be some other person who has made a similar deal of say rupees 53 rupees per kg for 20 kilograms, and so on so forth. So he had a very huge amount of people for that 100 kgs, and the prices are very different. So it would be a little bit tiresome process for him to like note down or to remember who made a contract and at what level. So this is something which was there prevalent in forwards as a derivatives. Okay, so in forwards there was no binding contract. People might like in this, like the situations we have already discussed, people might not enter the agreement because they are on a losing side. So just in order to overcome this situation, the concept of futures was introduced. Now, what actually futures is, we will have a definition of future contract. It is a financial contract. First of all, the very first thing that you should keep in mind is all the buying and selling that is done in derivatives market is just on a contract base. So a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or a financial instrument, at a predetermined future date and price. I hope the thing would have gone above your levels. Let me shorten it, simplify for you all. It is nothing, but it is just a contract where the buyer will be obligated, like it is a binding contract where buyer will have to purchase the asset once he enters the contract, or the seller has to sell the asset no matter if he is at a losing side or he's making a very huge loss. He has to sell the product, the contract. The contract can be in anything like any physical commodity or say financial instrument or any other thing. The prices will be predetermined and the date of contract will also be determined. In our case, we like finalize the price at rupees 55 on the very first day of getting into contract, and we took the time period as 2 months in our example which we discussed recently. So if I'm entering into a contract today, say it is today 23rd of July, then after 2 months, that is 23rd of September, I will be taking this asset. No matter if I'm making a loss or I'm earning a profits, I will for sure make the contract, like I will obey the contract, I will honor the contract, and will sell it off at the particular price which we have already discussed. Okay, so futures contract detail the quality and quantity. As we have already discussed the quantity, like in our case, it was 10 kgs of wheat. What about quality? There are like if you will trade in commodities market, every commodity should be of a particular quality. So this is something which we will learn in commodities market session. So for the time being, you can assume that yes, future contract details the quality of the product as well as the quantity beforehand only, and these are standardized in order to facilitate trading on future exchange. What exchange does in such situation? We will take an example of say stock market, say SBI future is also there in the stock exchange. So what will happen is, since there can't be any standardized value or standardized asset of SBIN. Uh, Usually what happens is, say you are making a contract, I and you are making a contract of SBI. You believe that SBI will go down in upcoming month or 2 month or so. So the current price right now is say 450. You think that it might go down to 430, and I am thinking that yes, SBI might go up. So we will enter into a contract among each other, and we'll finalize say a certain price, and we'll get into contract. But who will be the third party that will bind us? It will be the stock exchange. Now once I am into a contract of futures or say options or any sort of like contract, and there is a binding party as well, so I can't like deny to honor my contract or to honor my commitment, that yes, even if I am making loss, I will honor my commitment, and will square off or will book my losses. Okay, some future contracts do get settled with physical delivery of asset, but mostly the things are settled in cash. If you are entering into a future contract of SBI, State Bank of India, then you like at the end of your contract, you won't be getting the stocks of SBI. Whatever the profit you will make or whatever loss you will book, it will be deducted from your cash account, or it will be added in your cash amount that you have in your trading account. I hope I am making some sense and you all are with me till now.
Yes, sir.
Yes, sir.
Okay. Another thing which I wanted to convey you people, uh, by the term the standardized, I meant that there is a fixed expiry date of a contract, as well as there is a fixed lot size as well. If you want to enter into a future contract of say Nifty, then the lot size of Nifty is fixed at rupees seven, sorry, not rupees, at 75 units. So in order to enter the future contract of Nifty, you have to purchase Nifty in say you have to purchase 75 units of Nifty or in multiples of 75. So that means either you can buy 75 units of Nifty or 150 units or 225 and so on. So it is not like you can go into you can enter into a future contract and for 78 or 80 units of Nifty. No, you have standardized lot size that has been like uh, decided by the stock exchange. So you have to enter the future contract according to the lot size only. Everything in futures contract is based on lot size. In equity market or cash market, the lot size is usually one. So you can buy one stock of SBI or say 10 stocks of SBI, but you can't buy 9.5 stock of SBI. Similarly, in futures, you have predetermined lot size. You have to trade in that lot size only and in multiples of that. Similarly, another thing is there is fixed expiry date. We are talking about this term standardized. The first one is lot size is fixed. The second thing is in equity market, there is particular expiry of every future contract. You can't hold a contract for very long. Like there are three scenarios where the first month in is known as the near month, The second month is known as the next month, and the third one is known as a far month. To understand things better, say I have entered into a future contract of SBI in say month of July. So this will be my near month. The next month, that is August, will be my next month, and September will be my far month. So once the July month is over, now what will happen is now the August month will become the near month. September month will turn into a next month, and October will turn into a far month. Are you all with me till now? So the ones who square off their position in July month only, like won't like the ones who square off their position in July month only, like they wanted SBI to move up, it has already moved, so they have booked their profits and exited their position in the market. They won't be entering the next month. Far month is the maximum time till which you can hold on your position. After far month also, if you are making losses or you are into loss, you have to square off your position. The next thing which we will be talking about is what are the different types of position that you can make in a futures contract. So the terms itself tells you a lot of things. We have already discussed these terms in our basics of stock market session, in our technical analysis session as well. Like if you are long at a particular stock or a particular, it means that you're expecting that the prices will go up, and you are in the team of bulls. Like you want the prices, or you are expecting the prices to go up to a certain level. Whereas if you believe that in the upcoming few months the particular stock might go down, then you will create a short position. What do I mean by short position is you will short sell that particular stock. Now again, one benefit of futures contract is while you are trading in equities market and on cash basis, you can short a particular stock, but you can hold your position only for a single day. So if suppose I have shorted SBI today at say 11 a.m. in morning, I have to square off my position anyhow by 3:30. So say if SBI, or we'll take an example of Reliance just for a change, it was hovering around say 435 levels. I thought that it might go down to 420. So what I did is I shorted Reliance at 435 levels only. But now at 330, say 315, the stock is playing around 450. So what will I have to do is, according to the cash market, I have to square off my position right now. Like whatever the situation is, no matter what, I will book my loss of 15 rupees for this particular stock, and I have to exit my trade. Okay, but if I would have been trading in futures and options or in derivatives market, today Reliance was playing around 435 levels. I shorted it with a target of 420. It went up to say 450. even then I won't be like forced to square off my position. I can hold my position for 1, 2, or 3 months at maximum. So this is a benefit of futures contract. If you are shorting a particular stock, you can short that stock for upcoming, say, a very long period of time of say 1, 2, or 3 months at max. But while you are dealing in cash market, you are just allowed to square off your position at the end of the day. For those who don't know what short selling is, I will tell them in a very basic manner. You sell a particular stock at a higher level, and you think that the stock might go down, and you buy it at a lower price. This is known as a short sell in basic. But it might happen you sold it at say 150, and it has like taken a route back, and it has gone up at 460. From 450 to it has went to 460. So here you will book your loss of 10 rupees. Now we'll quickly talk about some very important terminologies. The first one out of which is spot price. What actually spot price is? It is nothing but the current price at which the underlying asset is trading in the live market or the stock exchange. You are entering into the futures contract of SBI. So, whatever the current price of SBI is, it is known as the spot price. If you will enter the script of like SBI futures, then whatever the price of NSE or BSE is known as the spot price. The second thing, lot size, which we have already discussed in futures or in derivatives market. Every future contract has a predefined contract size, which is referred to as a lot size. I'm sorry, I think I got disconnected. I'm sorry, I think I got disconnected. Could you please tell me like what was the last thing I was discussing?
Lot size.
Okay, so I'll quickly present my screen. I hope lot size is clear to everyone.
Yes, sir.
Okay. Yeah. So we will move on to our next terminology, that is cost of carry. What actually cost of carry is, it can be defined simply as the net cost of holding your position. Theoretically, the price of future contract is the sum of prevailing spot price and the cost of carry. For the formula of cost of carry, we have the spot price plus the interest value of your money, say, for holding your position in the market. So if you will look into a futures contract of, say, SBI only, the spot price of SBI is, let's suppose, 245 rupees today. So the future contract value of SBI ideally will be greater than 245 rupees. Why? Because it contains of cost of carry as well. So the spot price plus whatever the cost may be for you to carry or to hold your position in the market is determined as cost of carry. So if suppose the SBI is today at 245 rupees and the future contract value is, say, 247 rupees. So this 2 rupee will be your cost of carry. I hope I am making some sense. Guys, please let me know, like, are you able to
Sir,
grasp what I'm trying to say? Yeah.
Yes, sir.
sir, your voice is little bit breaking.
Is it breaking right now as well? Okay, just give me a minute. I will get back to you. I hope now it is better.
Yes, sir.
Okay, so did you all got the concept of cost of carry? Guys, please let me know so that I can move forward.
Yes, sir.
Yes, sir.
Okay, yeah, thank you so much. So now we will move on to our another term, that is basis. Basis is nothing but the difference between the current market price of the future contract and the spot price. So for this, we will have a very good example. Say if today the spot price, the future contract value, and what do you particularly determine with this? Okay, so we are taking an example of, say, Nifty today. Currently in market, for example, we'll take a scenario that Nifty is hovering around 15,500 only. There are three cases. And say if the future contract value is around 15,600. In our second case, it's around, say, 15,500 only. And in this case, it's this. Okay. So today, if suppose Nifty is in stock market, it's at position of 15,500, and the future contract value of Nifty is 15,500. Then you are paying additional 100 rupees, right? This additional 100 rupees is termed as premium. Similarly, If say Nifty today is hovering around 15,500 points, the future contract value is also 15,500, then you are giving additional zero, or this situation can be that termed as at par situation. Similarly, if you are paying like the spot price is 15,500 and you are getting a future contract at rupees only say 15,400, then you are making future contract at a particular discount. So this is known as basis. It shows you the difference between the current market price of the future contract and the spot price. If the future rate is say greater than the spot price, then it is known as a premium situation. If the future rate is equal to spot price rate, it is an at par situation. And if the future contract value is less than the spot price value, then it is known as at a discount basis or a discount situation. I hope I am making some sense. With this, we will move on to our another term that is known as initial margin. We have a very good example for this. If you remember in the very beginning of our session, I discussed with you all that derivatives market gives you a very high leverage. We are discussing this thing right now. Say if you are into cash segment and you want to buy a particular stock, say ABCD Limited, you want to buy 4,000 units and the rate that is the latest traded price is 100 rupees. So ideally you would require 4 lakh rupees just in order to buy 4,000 quantities of this stock, and you will make a certain like investment of 4 lakh rupees just to buy these 4,000 units of ABCD Limited. But if you'll enter a futures contract, then what will happen is the same ABCD Limited, the same quantity 4,000 rupees at the same price of 100, you will just need to pay a certain sort of margin money. In our example, I have taken 18% as margin money. So what do I mean by this? I just have to pay 18% of whatever the value of my position is. For 4 lakh rupees investment, I have to just make an investment of 72,000 rupees. And this is nothing but the leverage the stock brokers have provided, the stock exchanges provide. These margin requirements might uh, change with broker to broker, might vary, but yes, in the market like in this futures or in derivative segment, you get a very good margin like margin money. So you just need to pay a margin money and you enter the trade of 4 lakh rupees with just rupees 72,000. Are you all able to get my point?
Yes, sir.
Yeah. So
Yes,
this
sir.
margin,
Yes, sir.
very good. Thank you so much. Please be interactive so that I can also know that whether I am in the meet or are you all with me till now. Okay. So this margin requirement might vary stock to stock, from broker to broker, or from situations to situations. But the main thing which I wanted to convey you people is you just need to pay a little bit of margin money. You don't have to put your 100% money in that stock. The next topic which we will learn about or discuss about is a contract cycle. If I'm not wrong, I've already discussed this thing. There is basically all the future contracts do expire on the last Thursday of their respective contract month. We have three major months, that is a near month, a next month, and the far month. In our case, we discussed, July month was the near month, August was the next month, and September is the far month. What happens is, if say suppose you were into a future contract, you can exit your position anytime without any problem. Like if you entered a future contract into a future contract at say 9:30 today, you can exit at 9:35 as well. So you have no foundation of remaining in it for a long period of time. But yes, if you are sticking with the stock and you want, like, you are getting good profits, so nobody wants to exit while you are earning profits. So in such situations, every person is like bounded to square off their position either in the near month, in the far month, or in the next month. And like suppose my contract is to be like finished at the last Thursday of this month, that will be my uh, the last day till which I can hold on my position. At the last Thursday of this month, I have to square off my position, or I should convert myself into my new near month, or say next month. Okay, so this is something which is known as a contract cycle. We have three months. That is, first one is near month, the second one is next month, and third one is far month. Now talking about M2M, which is known as mark to market. This is a very easy terminology. We will understand this with an example. Okay, so let us suppose that today we have a trading balance of say rupees 1 lakh. Okay, and we want to buy ABCD limited future. The lot size of this stock is 4,000 shares. Okay, and I bought say 100 share, like at 100 rupees I bought one lot of ABCD limited future. So ideally, if I would have been trading in cash market, I would have paid 4 lakh rupees for this. But now I'm just paying 72,000 rupees. From where I got 72,000 rupees, I have already told you. It is here. We have the calculation with you all. You can go through this once again. So this is my margin money that I have to pay. Deducting 72,000 from my 1 lakh balance, I have 28,000 rupees back in my account. So if I want to buy another stocks or do any trading with this, I can do this. Okay, so suppose when I entered this ABCD limited futures contract, on the very day it went up to 102 rupees. So my profit for the day will be 2 rupees multiplied by 4,000 shares. So that is 8,000 rupees. And suppose the future contract of ABCD Limited, it closed today at say 104 rupees. So what will be my profit for the day? 4 rupees multiplied by this 4,000 shares. This is 16,000. That is my profit for the day. This will get add back to this 20,000, 28,000 rupees. So let's assume that we were like into the market only. The market has not closed yet. So in this situation, I made a profit of 8,000 rupees. Total mark to market will be 8,000. This 8,000 profit will be added to my trading balance, and I will be my trading balance will be 36,000. When the market closed, the price was 104. I got a profit of 4 rupees for these 4,000 shares. My profit is 16,000 rupees. This 16,000 rupees will get add back to 28,000 rupees, and it will give me 44,000 in my trading account balance. Let's suppose On day 2, the stock went down, and it went down to 102 levels. If you will see it in another way, you are just making a profit of 2 rupees. But looking at the previous day, where the price was 104, today the price has gone down by 2 rupees. So it is for sure a loss of 2 rupees for me today. So 2 rupees multiplied by 4,000 shares, 8,000 is the loss that I have incurred. This 16,000 is carried forward over here. So this 16,000 is carried forward over here. 8,000 minus 16,000 is 8,000 my profit, and this 8,000 will be deducted from 44,000, and my current trading balance is 36,000. Similarly, on day 3, it went down again, and now it went 4 rupees down as compared to previous closing price. So my loss in this scenario will be 16,000 rupees, as 4 rupees multiplied by 4,000. My loss will be 16,000 rupees. This 8,000 has been carried forward over here, and now I am making a loss of 8,000 rupees. Why? Because I had I previously I had a profit of 8,000 rupees, and I today I have made a loss of 16,000. So ideally I am making a 8,000 rupees loss today. So this 8,000 will be deducted from 36,000 rupees, and 28,000 rupees is something which is again back in my trading account. Now suppose on day 4th, I squared off my position at 101 rupees. So what will happen is your 72,000 rupees that was kept with your stockbroker as a margin will get back into your trading balance, and you made a profit of 3 rupees today. So 3 rupees multiplied by 4,000, to this 12,000 will be added to your trading account. This 8,000 is shifted over here, like the previous loss that we incurred. My subtracting 12,000 from this, it shows you 4,000 rupees, and the whole of 72,000 plus this 4,000 plus your 28,000 rupees gives you a value of 1,04,000 rupees. See, what I could have done is I could have taken a very simple example. I would have told you that say if today I squared off my contract at 101 level, 101 multiplied by 4,000 will give me the same value. But why I have discussed the same thing it every day is because I wanted you people to understand what actually M2M settlement is. If you will ever trade in futures or options or in any derivatives market, this is how you will get to know about what your mark to market for today or for this particular day was, for this particular session was. So that is why I have covered this thing for you. The calculations are pretty much easy. You could have taken the calculation as per your wish in any manner you feel suitable. But as I have to told you, make you understand what M2M settlement is, I have discussed this thing in a bit brief. I hope you all are you all got what I tried to convey you people about M2M settlement. If you have any issue, please let me know now only, since we are on the very end of our this whole session. Okay, so since no one is replying, I am assuming that everyone is cleared with M2M settlement as well. So now we will quickly move on to things which you should remember. Remember guys, in whenever you are into any derivative market or any market, time does matter. Futures are the contracts which expire on the last Thursday of the respective contract month. This is something which we have already discussed. You can't hold your contract beyond your contract's expiry date. So You should keep in mind what time frame you are taking, and you should enter the contract as per that time frame only. Rollover is a very easy concept, but most of the people think that this is something which is really hard. But for you people who are just understanding the basics of futures or derivative market, rollover is nothing but it is a process in which the traders can carry forward their position in a futures contract. Suppose you entered in a futures contract of July, and uh, of say SBI. It gave you a very decent return, but you are still bullish that is still bullish on SBI, and you think that it might go up in upcoming 1 or 2 months as well. You can use this rollover facility, and you can like square off your position from this particular contract and enter into another contract of same value only. So this, whenever a person squares off its position and enter into another contract of same script with a very with another opinion of being bullish or bearish, this process is known as a rollover. The third thing is no ownership. Since futures are just contracts, you are not termed as shareholders, or you won't be eligible for any dividend, bonus, or stock split, right issue, or anything that has been done. Like if you are into a future contract of SBI and SBI declares a dividend, you won't get that dividend because you have just entered the future contract. You have not purchased these shares. Whatever your profit or loss will be, that is just the return that you get. And if you will square off your position, or you will make a position every time you will deal just in cash, nothing else, you won't be getting any stock in your demat accounts if you are entering into derivatives market. Last few things, there is unlimited profit and unlimited loss. In case the price is going up in your long position, you can get a very good unlimited profit. But at the same time, if prices fall, then you have to maintain the particular amount in your account, and you have to square, like you have to bear the losses of obviously you can square off your position earlier, but there is a very good extent to which you might earn profits and you might lose your money. Similarly, this is no circuit limit. This is the term which we used, which I told you in our basics of stock markets. There I also discussed that in derivatives market there is no circuit limit. So if suppose SBI is there in derivative market, you won't see a news that SBI has hit a say an upper circuit or a lower circuit. Even this is the reason why SBI don't like hit upper circuit or lower circuit. There are various stocks that have been listed in derivatives market. So for them, the upper circuit levels or lower circuit levels don't matter. Another fun fact that I wanted you people to know is, since we know that you have to square off your position at the end, or like the last Thursday of a particular month, every time you if you want, you can go and watch out the market on every Thursday. And yeah, on every Thursday, Bank Nifty and Nifty will have a very good movement. What can be the reason behind this? What is the reason behind this? In while you are in derivatives market, for every stock or every contract, you have to square off your position at the last Thursday of your respective contract month. But in case of Nifty and Bank Nifty, you can swear off your position. Like there is weekly rollover also, like weekly contracts also. So a person can enter into a weekly future contract for Nifty and Bank Nifty. So this is the major reason why Bank Nifty and Nifty shows a very good volatility on every Thursday. So this is something which you can keep in mind and can make your calls accordingly. So guys, this is what we had planned for you for today. If anyone has any doubts, you can ask me, or yeah.
Yeah, no doubts. So,
Okay, so like, will you all were you all able to understand what I tried to convey you? Like, if anyone has any issue, you can reach out to us.